For today's interaction, I'm joined by my colleague Chirag, and we have with us Vinay Paharia, CIO at PGIM India Mutual Fund. Vinay, welcome and thanks for joining us today.
Thank you. Happy to be on your show.
Diving right in, you've been in finance for over 2 decades. Can you tell us what sparked your interest in equity investing?
Sure. So actually, I've been born and brought up in a joint family setup. So right since childhood, I've been hearing all the dinner table discussions around investing and the ups and downs of the market and how exciting this entire phase was, the bull markets, the bear markets. So all of that had a very interesting and lasting impression on me. But I never thought that I could make a career out of it. Till my first year at MBA, I did not have a very clear goalpost on which stream will I choose, etc., etc. But during my summers at in fact, during one of the interviews for summers, my interviewer mentioned that, have you heard about equity research, so on and so forth. I said no, but I'm interested in stock markets. So he said, have you read about anything and any investor? I did not read anything. So he said, I'll recommend you a book. It's called One Up on Wall Street by Peter Lynch. So that day immediately I got and bought that book and read it, and it was like magic for me. Deeply interested in what was written in this, and it opened my eyes to actually what all of this investing was all about, what caused stocks to go up, down, etc. And then one thing led to another. I discovered Warren Buffett's writings, and then I discovered Joel Greenberg's writings and all of that. But I think the trigger was more of Lynch's book.
Okay. Vinay, you have been you evolved from being an equity analyst to a fund manager. Reflecting on your analyst days, could you share a couple of key lessons that really stuck with you in your role today?
Yeah, I think it is always a journey, and you can't jump from one role to another without adequately absorbing the learning from each of the role. It is just like the steps in the career. You cannot skip any one of them. So when I was an analyst, my objective was to delve deeper into each of the companies which I did work on the sectors which I did work on. I was very fortunate to learn the nuances of valuation and the nuances of what is a good business, bad business, very early on in my career. In fact, at that very time, I had been reading about Joel Greenblatt, about Seth Klarman, about some of the renowned hedge fund investors in US. And I think all of them helped shape my understanding as an analyst about a company. Thereafter, after about 4 or 5 years as an analyst, I worked as a fund manager. And here, you needed to have a much wider bouquet of knowledge. So the depth is anyways given, you need to know, but the breadth is humongous. The expectation is that the fund manager should know about every company which is traded, which is listed, about every sector. You cannot come and say that, my knowledge in banking is lower. I mean, I was a consumer analyst. How do I know this? That's absolutely not a given. You need to have a breadth of knowledge as a fund manager. After having absorbed all of that, the relative understanding of benchmarks, peer group, etc., then you move on as in your role as the chief investment officer, which is once again a very different role than a fund manager. This role requires me to set up systems and processes, ensure that the team, which is the fund managers and the analysts, are able to operate in a free and fair manner. They are able to operate in a manner which will produce the desired outcomes, and hence my objective would be to set up systems and processes as the chief investment officer. The focus is on team building, on mentoring, on leadership, and ultimately being responsible for the overall investment platform to deliver long-term investor, regulator, and the other stakeholders' expectations. So, but the key difference is that you keep zooming out as you move up in your career ladder.
Right now, starting in 2002, you weathered bull markets and global crisis early on in your career. What key insights did those experiences leave you with?
Sure. So I think all phases of the market, be it bull markets or bear markets, bring in different types of learnings, understanding, and they're all associated with very, very different emotions. So clearly, bull market is symbolizes greed and raw greed. So I have seen that very closely even before I entered formal investing in the year 1999. Then, as a professional analyst and fund manager, I witnessed it in full bloom in the year 2005 to 8. And there are various other phases. So what I discovered is that in a bull market, experience becomes a baggage. Experience becomes your enemy. So the lesser experience you are, the better is your performance, because you tend to have not any baggage. You don't look at a manager's quality, you don't look at company's business quality, etc., etc. You only focus on the future. Sometimes it's good, and hence one of the learnings is to ensure that you reduce your biases, increase your due diligence. Absolutely. So in a bull market, since everything keeps making you good returns, you keep on dropping your guard in terms of due diligence. I think that is a very big mistake if investors make it. You need to increase your level of due diligence as your returns keep on climbing higher, because most other people will be dropping their guards. In fact, I would say bull markets are a phase where markets are completely like voting machines. Over a period of time, of course, over a longer period, markets do become weighing machines. So all of the fluctuations in the stocks which we see are actually all of this results in a stock being fairly valued by the market. So I think over a long period, yes, markets will be weighing machine, but in a bull market, it's definitely a very strong voting machine. So I would say that another learning is don't extrapolate your near-term trends which get visible. Like, for example, during the early infrastructure power boom, most people extrapolated very strong power demand and demand for thermal energy, so on and so forth. In the IT boom, people extrapolated 100% growth in software business. We have to remember that trees cannot grow to the sky. I think those were some of the key learnings during the phase of bull market.
What about the bear markets?
Bear markets, of course, bring in their own set of challenges and opportunities, and I think it's more an opportunity for investors than challenge. The challenge is more on the emotional side, because clearly when you're dealing with money and your hard-earned savings, and you look at your savings being marked down by market every day, it is a very, very tough sight to visualize. So suppose you are living in your house and every day you get a quote for your house, and every day some person comes and tells you today the price of your house has gone down by 5%. Next day, once again, the guy comes and tells you it's down by 5%. The third day, you will ask this guy not to come to your house, right? So that's what happens to most of the television channels. People just switch off. So I think that happens in the bear market, but those are the markets where you actually get most of the investing opportunities, because people tend to ignore the valuations of companies, what fair values are, and it is in those times when markets inefficiency comes to the fore, because whatever be the price, people just want to get out, because it's a very emotionally challenging phase for most of us. It's not easy. I would also imagine that if I was in an investor's foot, I would definitely be doing the same thing, maybe driven by fear. But I think as a professional investor, we are trained to ignore most of this noise. And I think that's what we learn through bear markets.
Vinay, now coming to your investment philosophy, you've been in the industry for a long period of time. So can you just share what's your brief investment philosophy, and which are the kind of markets or the situation which excites you?
Sure. So I can simply answer the second question first. Of course, bear markets are more exciting for the simple reason that you always get whatever you like at a very high potential upside. So bear markets are absolutely great, delight for an investor. But I think, as we discussed, they have their own challenges. In terms of my philosophy, it's work in progress as always. You keep learning, you keep reshaping, remolding your philosophies. So, for example, uh, currently we have adopted a very straightforward, simple philosophy there, which is also evidenced by a very long-term study on the Indian markets. So we did a very long-term study of 20 years 25 years in the Indian market as to what are those durable factors which have delivered superior returns. And these factors cannot change from time to time and cycle to cycle. So these are durable things which an investor can adopt and create portfolios. So what we discovered through very painstaking research over the last 25 years is that companies which have stronger or higher than average growth and also higher than average quality, which means returns on equity, a combination of these companies or portfolio of such companies, if we hold on for at least a 3-year period, has performed much better than the market over a longer period of time. So on a rolling 3-year basis, such a portfolio has delivered superior returns at least 2/3 of the time in the last 20 years. So I think that is a very important outcome of this study, and it just solidifies the approach which we have adopted, and that, in summary, encapsulates how our philosophy gets shaped up. Additionally, we would want to ensure that we diversify a lot and we hold companies for a longer period of time. So low churn.
So nothing like, you look for a value or a GARP strategy or a growth strategy, nothing on that particular lines as of now.
Yeah. So as I've discussed just now, that we want to buy companies which are growing faster than average. So definitely it's a growth strategy. So we would definitely want to buy companies which are growing faster than average and companies which have higher than average quality in terms of business. Now, the third question is, how do you arrive at valuation? For that, we have devised a approach which is embedded in financial theory. So we just don't look at simple P multiples, because P multiple is an outcome of 4 factors. And these 4 factors are forward earnings growth, forward returns on equity, the interest rates, and the riskiness of the underlying business. All of these 4 factors together create a unique multiple for each company. It's like the fingerprint of a human being, right? Everyone has a unique fingerprint. So similarly, every business at a particular point of time will have a unique fair multiple. So our objective is to buy companies which are available at a price which may be slightly lower than the underlying fair values as at that point of time, or they present a greater potential upside over a 5-year period. So the way we approach all the companies in the universe, we have about 180 companies in the fund house universe which possess this characteristic, which means they are having better than average earnings growth and they are having better than average returns on equity. So of these 180 companies, we have fair values for all of them right now. And depending on the market price, we look at what is the potential upside if we hold on to these companies at the current market price over a 5-year period. And based on this, companies which possess the best potential upside are companies which are the most attractive, and vice versa. So that is how we approach valuation.
You were earlier with the Union MF, and now you have joined the PGIM India MF. So just wanted to understand, even the CIO at Union Mutual Fund. So what triggered the move to come and join PGIM India MF?
So there are personal reasons for the move. There is an element of career progression. There is an element of better prospects, as you would imagine. PGIM has a parent which is a very large global fund house. They offer a much stronger and a bigger vision from a global perspective. And I think that is something which is particularly exciting for an investment professional to sit together with other investment professionals globally, and then to discuss and bring in capital for work in India. I think those are some of the things which was particularly interesting.
Right now at PGIM, managing equity and hybrid strategies across 10 schemes sounds like a massive task. How do you and your team tackle it? How's the work divided?
Sure. So as you rightly said, Ruchira, first and foremost, the funds are not just managed by me. It is actually managed by a team of managers, and I am just one of the co-managers to the team.
Mhm.
And how do we do this? The decisions are taken by the team of fund managers. It is a very methodical and a very process-driven investment approach, wherein we just buy. So first we isolate all the companies which are superior quality businesses, which are growing fast, which we call as companies which are in the fund house universe. As I discussed, we have about 180 such companies in the universe. And these are companies which are identified. We have the fair values of all of these companies with us. And then we create portfolios, once again, which are very methodical. There are clear guidelines and guardrails to creation of portfolios. For example, we want to ensure that we are creating diversified portfolios. We are creating portfolios which are true to mandate. We want to target a higher than peer group average active share. Very crucial. So whenever a manager makes any decision, he would want to check, is it going to result in increase in the active share or reduction? The objective is that the active share should keep rising so that overall portfolio active share is better than peer group average. We would also want to ensure that the fund managers are making long-term decisions, and hence we are managing funds for the long term, not having a high portfolio turnover ratio. So I think a combination of all of this ensures that there is a repeatability in what we are doing. There is no dependence on a single person, and there is an institutional element to what we are doing. So as I have been highlighting, investing is a blend of art and science, and our job is to infuse as much science as possible into this art so that it becomes much more repeatable. And I think that's how we are managing the funds.
Vinay, I would like to little bit, extend it. So basically, if there is a stock, particularly if the fund manager wants to buy, I mean, who's the final veto while buying or selling a particular stock from the portfolio?
So it's there is no such thing as veto per se, unless and until there is a company which has the veto comes in at the time of inclusion of a company in the fund house universe. So when we are evaluating a new company, let's say the analyst team is discussing, the fund managers are discussing a company, and everything looks good, but there can be some gray area as far as management quality is concerned, and maybe at that time I would want to use my veto in not including the stock in the fund house universe. But once the stock is included in the universe, it means it is ticking all the boxes of good quality business, good management, and if the fund manager is looking to buy it because it is available at a fair valuation, then I think there should not be a big challenge. In addition, we also have various other guardrails as far as managing the fund is concerned. If the guardrails are clearly being taken care of, generally we do not have a one single person making a very big decision. So it's a team of fund managers, I would say, Chirag, that makes the decision. Either of them would press the button.
Vinay, the another thing was, you joined PGIM India in last year, so it's been around 1 year at the fund house. So have you made any major changes to the research or the stock selection process at the fund house?
So I think I was fortunate that first and foremost, PGIM has been a fund house which followed GARP philosophy, which is growth at a reasonable price. So ever since we started out as PGIM, we have followed a growth at a reasonable price philosophy. My objective when I joined was to ensure that I sharpen this investment process further, bring in more evidence-based investing, and as I said, infuse more science into this art. I also added a filter on quality. So while it was growth at a reasonable price, we made it quality growth at a reasonable price after we looked at what is the impact of this study. So that important quality filter got incorporated. We also incorporated the fair value framework for each and every company in the universe, which means instead of looking just at the P multiple for that reasonable price, we looked at fair values for each of the company for the reasonable price. So I think all of those on the margin tightening of parts of the process is what I've been doing and spending most of my time.
Moving on to a couple of fund specific questions. Some of your equity funds have seen performance dips recently. So how are you planning to steer them back to prominence?
Sure, Ruchira. So I think our performance has been weak, especially it's been significantly weak this year. And there is a very specific reason for that. This year actually has been unprecedented in a particular trend. And this trend is companies which have got lower than average growth and lower than average quality have significantly outperformed companies which have better than average growth and quality. So we did the same study for NSE 500 companies, all the 500 NSE companies, and we looked at the median returns of companies which have got better than average growth and quality and median returns of better than average lower than average growth and quality companies. So weaker companies this year have delivered 65% returns versus 35% returns for good quality companies. And the gap is a massive 30%. This is unprecedented because never in the history have we seen such a huge gap open up in both these segments of the market. In fact, there have been instances where this gap of lower quality companies outperforming the good ones by maybe about 5-7%, 8% per annum, but that's about it. The magnitude of underperformance of good companies this year has been significantly higher. And as I've discussed during the course of this discussion, our investments are largely concentrated in high quality and high growth companies. And because of which our funds have underperformed. In fact, the math for performance this year is very straightforward. You look at the benchmark, let's say the small and mid-cap benchmarks, the contribution of lower quality and low growth companies in these benchmarks is approximately 30 to 35%. Whereas in the large cap benchmark, which is let's say NSE 100, the contribution of such companies is just 11% from a weightage perspective. And hence, if you look at the gap of underperformance for, let's say, a mid-cap or a small-cap fund with the benchmark this year would be far, far wider versus any large-cap fund. And remember one more aspect. From the year 2018 to 23, the same benchmark was actually underperforming almost every mutual fund which was trading. So I think this has been a particularly big challenging year for our kind of investment philosophy. And there have been some other hits in sectors like, for example, we have been overweight in consumer discretionary. We have been overweight financials, and we had been underweight utilities and industrials. So both these kind of positioning also hit us. We have more or less balanced our portfolios, so sector positioning does not impact us anymore. But stock selection is an area where we got significantly impacted this year. I think this kind of a phenomenon cannot last long for the simple reason stock price are just slaves of earnings. So to give you some more data, for example, from the year 2018 to 2023, NSE 100, which is large cap heavy benchmark, delivered an earnings growth of 11%. And the index also delivered 11% return. Similarly, mid and small cap benchmarks saw an earnings growth of roughly about 8 and 9%, and the returns were also around 8 and 9%, almost in line with the earnings growth. You know what has happened this year? We have seen the NSE 100 deliver 45% return till 29th of February from the 1st of April 2023. And the underlying earnings growth was 27%. So a little gap, roughly 20% gap. However, the mid-cap and small-cap indices have actually crossed all limits, which means they have actually seen 25% earnings growth, and the returns are 57% for mid-caps and 70% for small-caps. So I think clearly the benchmarks will catch up. We have borrowed returns from the future. So either there will be a time correction or a price correction in many of the low quality and low growth small caps and mid caps. In fact, we have called out this as a big bubble which is brewing in the market in the current environment. High quality and high growth mid caps, small caps, and large caps are still available at reasonable valuations, according to us.
You highlighted a point like P, like there is no particular high P or low P, and you are likely to bring out some paper. So I was just going through the portfolio of PGIM India Midcap Fund, and portfolio is around the P ratio is about 45 or 44, sorry, which is compared to the pace is much higher. So how much does the high valuations or this high P portfolio concern you?
Yeah, so you can imagine it like this. A public sector bank will be trading at 3 or 5 P multiple because they have recovered some money this year. They would have seen bond gains in their profit books this year, which is not recurring. So as an investor, you have to see what is the long-term return on capital which I'm going to get, and what is the earnings growth which I'm going to get out of the companies which I'm investing in. Most of the companies in the benchmark are in this category where you're going to see very low earnings growth. Returns on equity are going to be extremely low, because of which they are trading at a lower valuation. Some of the companies are in the early phase of growth for many of our mid caps and small caps. And hence, on an optical basis, the portfolio appears to be trading at a higher valuation. But as I said, if you do a very simple valuation math, take an example of a growing annuity to perpetuity, you will see that a company which has even a 1% higher growth will have a significantly higher fair P multiple compared to a company which has got a lower 1% lower growth. So I would imagine that our portfolios of companies is not trading out of whack with their historical valuation, whereas most of the market which we are looking at, the absolute multiple, actually they're trading at a much higher valuation than their own traded history.
Just on this thing, what's a high P according to you, and what's a low P? Means just means on a blank of it, we just look at the high P like 100 P stock or a 120 P stock, and 30 P stock. So what according to you is a very high P stock and a low P stock?
I'll give you a simple example, Chirag. Let's say you have a company which is going to grow at 5%, and your cost of equity is 10%, and this company is going to give you let's say a dividend of it's the earnings per share is 100 rupees, based on whatever ROE assumptions, etc., we arrive at a fair multiple for this company at 15. Now, if the growth goes up to 8%, the same company's fair multiple goes up to 30 times. If the growth falls down to 2%, the same company's fair multiple goes down to 11 times. So now tomorrow, if let's say the growth goes up to 9 or 10%, and this growth is growth in perpetuity, you can't have a growth which can be equal to equity's cost of equity. So there is a cap. But as you keep increasing the growth, the fair multiple exponentially keeps increasing. And that is why you will see growth stocks are also long duration stocks. In an increasing interest rate regime, growth stocks will be the most impacted segment of the market because they are high duration assets. When the interest rates actually fall, you will see the multiples expand for the growth assets, which is exactly what happened. When the interest rates were falling from the period 2010 to 2020, you saw growth stocks kept on going up. And from 2020, when interest rates started going up, most of the growth stocks started to see a weakness relative to the lower growth ones.
So moving on to the last question. Now, given the current scenario in the market, which sectors or themes are you finding most appealing right now?
Right. One of the sectors which we like the most, where we think valuations are reasonable despite very high potential growth, is healthcare. So within healthcare, we like companies which are selling branded domestic formulations and companies which are in the hospital services space. These are companies which will see a sustained benefit of growth in India's nominal GDP, growth in the per capita income, because whatever research we do on global markets, one of the most common element which comes out is that as the per capita income goes up, the spend on education and healthcare goes up disproportionately. Mm-hmm. And this is getting reflected in the revenues and the profitability of many of the companies which we are invested in. And I think that's an opportunity, a structural long-term opportunity, which is still reasonable, and we are significantly overweight in this opportunity. The other one is an opportunity which is contrarian in this market. It is the financial services sector. We like most of the lending, private sector banks and non-bank finance companies on the private sector side, because these are businesses which have consistently generate above average return on equity, and they are also growing at a faster than nominal GDP pace. So this is another area which we like. Here the valuations are very attractive. The third segment which we like is consumer discretionary space. This contains or consists of a whole host of segments of market like organized retailing, auto ancillaries, original equipment manufacturers, some of the contract manufacturers on the digital side, so on and so forth. This is a space which has undergone weakness, as during our discussions we have discussed that consumer discretionary has underperformed this year, and hence valuations have turned very attractive. And this is a space which we like a lot.
So Vinay, you feel there is a so-called froth in the small cap and the mid cap segment of the market?
So actually, we have called out a very specific segments of the market where we think there is froth. We call it micro bubbles, which are brewing in the market. So according to us, micro bubbles are brewing in low quality and low growth small caps and mid caps, very clearly. The third segment is the newly listed IPO companies. Fourth is some of the public sector enterprises which have actually run up significantly ahead of their underlying earnings. Fifth is a lot of the real estate companies, especially the residential real estate companies. Sixth is companies in the industrial and cap goods segment, including companies in the railways segment. And seventh is the micro caps and the small and mid cap, SME companies. So these are specific areas where we think there is a red flag, there is froth, and there is a potential for significant principal loss in these areas.
All right, that wraps up our chat for today. Hope our viewers benefit from the insights that you've shared. Vinay, thanks a ton for spending time with us and diving deep into these questions. It's been great having
Thank you. Thank you. It's been my pleasure. Thank you, Ruchira. Thank you, Chirag.